The goal with asset allocation and your asset allocation plan is really to take investments that have volatile characteristics, blend them with investments that have less volatile characteristics or contrarian characteristics, and that's going to reduce the overall volatility of your portfolio. So, for example, stocks might be your most volatile asset class, and when you blend those with bonds, you might get a completely different ride out of your bond portfolio. Bonds tend to do opposite of stocks. And finally, if you look at things like investments in alternative asset classes, you might get a completely unrelated and wild ride. But the purpose of the asset allocation process is to take your investment assets, and this is just 3 asset classes. We've got to include things like large companies, small companies, value, growth, international emerging markets. You might be invested in high yield bonds, municipal bonds, short or long term. But we take these asset classes, we blend them together, and that hopefully is going to give us a ride that is much smoother, all things considered, than the individual parts of the portfolio. So we already know that portfolio rebalancing can control your risk. But the question is, can portfolio rebalancing actually make you money, as I've been gently pointing out throughout this article, this blog post, and these videos? And if you consider, for example, stocks that have a wild ride throughout the year, typically, versus bonds who have maybe the opposite ride throughout the year, you can take a look and see that there's points right here where you would buy bonds from your stock proceeds. There's points right here where you would sell your bonds and actually buy your stock securities, only to find that rise coming up next, at which point you would sell some of your stock and buy your bonds with the proceeds, and on and on. So the answer is you're constantly taking assets that have outperformed and you are buying assets that have underperformed. So you tell me, this is the ultimate buy low, sell high strategy. Can portfolio rebalancing actually make you money? I believe that the answer is yes. It's proven time and time again, and it is also why Vanguard puts a 0.35% bump on your overall performance. If you read that Vanguard study, if you rebalance your portfolio, it should add about 1/3 of a point to your overall performance. So the question about portfolio rebalancing, a very critical question, is when should I rebalance my portfolio? And what most advisors will do is they'll just say, oh, rebalance it annually. And for example, you put your asset allocation into place on January 1st, and then on January 1st of the following year, you're going to go back in and take a look and say, oh, I've got to sell some stocks, buy some bonds, and within the stocks, I've got to buy some small caps and sell some large cap, or something like that. The problem is I just don't think that cut it. I am not a big fan of annual rebalancing. It just doesn't do enough to capture the risk mitigation factors of rebalancing as well as the buy low, sell high factor. So let's just say, for example, we've got 2 indexes and we're going to start with 1,000 on, let's just say, the stock market. And that stock market's going to go and cruise up through mid-year to 1,500 and down at the end of the year, just like any other year might do. So you've got this point in here where you're actually up 50%. The stock market was really hot mid-year. And then conversely, you've got this bond portfolio that also started at 1,000 and dropped to 800 mid-year. And so now you've got this 800 on your bond portfolio, and it's cheap. And that means it's down 20%. So it doesn't matter where you start, you have these points in time, start and finish, where you're at 1,000 on the bond index, on the bond market index, and you're at 1,000 on the stock market index. Rather than just look at this on an annual basis, we take a look at it on a monthly basis. And you kind of get the point here, and forgive me if there's not 12, but you get the point. We take a look at it more often. It doesn't mean we trade more often. We may only trade up here, and then we may trade again up here. We may be buying some bonds down here. We only may trade once or twice per year, but we're looking at it more often to capture these portfolio rebalancing opportunities, which makes a lot more sense over a long-term retirement or financial plan. Okay. I can't get too in the weeds here on this one because it is a much, much bigger discussion. And I can, however, discuss it at a very high level. We're talking about asset location, not asset allocation. Asset allocation is the process of determining how much of your investments assets go into certain asset categories like stocks, bonds, large companies, small companies, etc. This is asset location. So where do we take those asset classes and put them? And the reason this is important is because you typically are going to have different buckets of money. And those buckets may be, for example, your Roth. Well, your Roth IRA has certain tax-free forever implications. And so it's important to consider what asset classes you put there. You may also have, for example, an IRA or 401k, anything that's pre-tax. So this is, we'll just call it the IRA, but it could be 401k that's mostly pre-tax. And you may also have, for example, some taxable assets or investments. So that's taxable, meaning that it's like a savings account, checking account, a regular mutual fund. You're going to pay taxes on every year. Oops, forgot my handle there. So you've got these different buckets, and we could make it really complex and talk about insurance, annuities, things like that. But the problem is not all of your investment assets are treated the same. So, for example, you've got in your portfolio international stocks. So you've got INTL. And then you've got emerging market stocks. You've got these asset classes. Believe it or not, they're incredibly tax efficient. Why are they incredibly tax efficient? Because you're paying taxes to foreign governments. So these types of investments are going to typically go into your taxable portfolio. But before I get ahead of myself, what we've got to be concerned most with is your Roth IRA here, because your Roth IRA is going to be the most advantageous account that you have outside of a health savings account, which could be triple tax-free. Go check out my other blog on health savings accounts. But you've got your Roth IRA here. So what you want to put there, typically, most people, is the most aggressive investment. So your most aggressive investments, let's just say, are going to be your stocks. Do you want to put international and emerging? Personally, I don't like to. I would typically put my U.S. stock, and the only reason is the international has different consequences like the currency exchange and so forth. I would typically fund my Roth IRA first with all of my U.S. stocks. No matter how big my Roth IRA is, I'm going to just jam it full of U.S. stocks. And if I had a choice, I'd put my more aggressive U.S. stocks in there. Maybe that's a small cap fund or something like that. That always comes first. You want to fill up this bucket. Once this bucket is all full, then you go on the asset location approach, which is now what's next. I've got U.S. stocks. I've got right here. I've got my international and emerging markets, which are highly tax efficient there. Well, it just so happens that U.S. stocks are also very tax efficient. Now, things like large cap value, small cap value, they're going to pay a higher dividend. They're not as tax efficient as things like large growth, small growth. So you've got to kind of take a look at these different aspects if you really want to get into the weeds. I'm just giving you the general overview. And now you've also got things like your bonds. Now, I'm not talking about municipal bonds. If you read the blog, you'll notice a very quick story wherein I was very new in the business, 1995, wet behind the ears, all of about 21 years old. New client walks into the office at Morgan Stanley, brings me a Primerica statement, Primerica Financial Services or whatever it is. And they literally showed me their IRA. It was like $100,000 at that time, IRA, with municipal bond funds in it. And if you understand the gravity of this, that's the type of advice that is floating around out there back then and unfortunately still is today. We still see it every day. So going back to the asset location discussion here, your bonds are typically going to be, unless you're in a super high tax bracket, you're going to be taxable. And those bonds want to go into that IRA. So we want to fill up that IRA with bonds that are taxable. This is going to do a couple of things. Number one, that IRA is going to get bigger over time, right? So as that IRA gets bigger, you're going to have to pull that money out and pay dollars to Uncle Sam. And we want to basically control that growth in the IRA to control your future taxes. So that's one thing to keep in mind when you talk about your bonds going into the IRA and so forth. So again, real quick, we're going to do the Roth IRA. We're going to fill that up first. We're typically going to use U.S. stock. It's a little bit of a home bias. You can research that. And then we're also going to use the U.S. stock into the taxable portfolio. And international and emerging markets are very, very tax efficient due to the foreign tax credit. We definitely want those to go into the taxable accounts. So when you get those 1099s at the end of the year, they're going to be smaller because they're more tax efficient. We definitely want to take the bonds and we want to fund that IRA that is pre-tax. We're assuming it's pre-tax and not something that you didn't take a deduction on. And that is going to lower your overall taxes. And when you do portfolio rebalancing, bringing it all home here, you need to keep this in mind. As you're going to rebalance your portfolio from year to year, month to month, decade to decade, you want to make sure you're guiding your assets into this asset location type of strategy.